Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, October 14th, and we'll see how things look for Wednesday, October 15th. Going over the action in the market on Tuesday, the S&P 500 continued its attempt to recover from Friday's sharp 2.71% decline. After regaining about half of those losses on Monday, the index closed slightly lower on Tuesday, down 0.16%. With below average volume. Early selling pressure was set off by buy the dip activity, but late day selling pushed the S&P below the unchanged level and the daily pivot at 66.48. The S&P 500 continues to close below its 20-day moving averages, but is holding above the 50-day moving averages, while resistance lies at 66.75, close to the 20-day moving averages. The index did gap lower at the open below S2 at 6,600, but managed to rebound above S1 at 66.27 by the close. Looking at the broader market, geopolitical tensions are continuing to weigh on sentiment. News of China sanctioning 5 U.S subsidiaries linked to South Korea heightened fears of an escalating U.S China trade war, contributing to market uncertainty. On the earnings front, bank stocks showed mixed results after reporting strong earnings. Wells Fargo and Citigroup performed strongly, while Goldman Sachs and J.P. Morgan Chase closed lower. Sector performance was uneven. Mega-cap tech and discretionary stocks underperformed, while small and mid-cap stocks displayed relative strength. There continues to be a flight to safety, with investors shifting from stocks to bonds. This is pushing the 10-year Treasury yield down even further to 4.02%. Meanwhile, the U.S. dollar weakened slightly, which is likely providing some support to stocks, even though the drop in yields reflect growing risk aversion. Looking at market indicators and sentiment, the short-term trend remains negative. However, the intermediate-term trend is weakening but still positive. The long-term trend remains firmly positive. The VIX climbed back above 20 again to settle at 20.81, which historically signals potential negative annualized returns. Market sentiment continues to decline, dropping to 30 from 33, raising caution among investors. Momentum indicators are mixed, showing no strong conviction in the short term, either up or down. On the policy front, Federal Reserve Chair Powell highlighted rising downside risks to the job market, while Boston Fed President Susan Collins supported modest rate cuts as inflation eases and hiring weakens. The markets are continuing to price in rate cuts for both October and December, assuming no major surprises. Economic data was quite limited due to the government shutdown. The NFIB Small Business Optimism Index fell to 98.8 from 100.8, which always raises some concern since small businesses are major employers. In the commodities space, gold and silver remain overbought, with gold nearing a trendline resistance that tested back in 2016 and 2020. Investors appear to be chasing precious metals, driven by the fear of missing out. In terms of sector and asset performance, small and mid caps outperformed large caps, though claims of a small cap breakout appear to be premature. Defensive sectors, including staples and industrials, held up better than tech and discretionary. Looking at oil, market projections suggest a potential oversupply by 2026, which could lower prices unless geopolitical events disrupt the outlook. Moving on to the technicals, the S&P 500 is currently in a neutral zone, caught between resistance at the 20-day moving averages and support at the 50-day moving averages. A break below the 50 days or above the 20 days will likely signal the next trend. Gamma exposure points to resistance at 6,700, while support levels reside at 6,600. A bearish Hindenburg omen signal from October 10th is still pending confirmation by November 7th. On the bullish side, a potential Zwag NYC breadth thrust would be confirmed by October 24th if it reaches its target level. Smart money indicators, including the Chaikin money flow, are turning slightly positive, while the Chaikin oscillator is turning slightly negative. Looking ahead to Wednesday, October 15th, the S&P 500 is likely to remain range-bound unless a clear catalyst emerges. Seasonally, October 15th is neutral to slightly positive, and we're in options expiration week, which historically has closed higher 73% of the time going back to 1980. Economic data, if not delayed by the continued government shutdown, will include the MBA Mortgage Applications Index and possibly the Empire State Manufacturing Index. Geopolitical tensions, particularly around U.S. China trade issues, will remain a key focus for investors. It's best to keep an eye on these developments as well as the technical levels that have been discussed for signs of a potential breakout or breakdown. In conclusion, the S&P 500 is navigating a short-term negative trend, but remains positive in the intermediate and long term. It's caught in a tug-of-war between resistance at the 20-day moving averages and support at the 50-day moving averages, with mixed sentiment and no clear direction. It's best to stay vigilant, monitoring U.S. China developments, upcoming economic data if released, and key technical levels for the next move. Thank you very much, and I will talk to you in the next podcast.